Welcome, everyone. You're listening to Nephology, the podcast dedicated to crypto, accounting, business, finance, and much, much more. I'm Joe David, the founder of Nephos Group in Myna. Please note that all conversations recorded are professional opinions, and if you'd like to know more or gain support, please reach out to the team directly. Now on to the next episode.
Right, so I'm now at the wheel. Me and Jamie are at the wheel. And yeah, we are going. Today, we are going to talk taxes and what is a tax.
What is a tax?
And how do I pay as little of it as I legally have to? Or in some cases, the questions we get asked, not legally, but I say asked as if we would get asked that. But you always hear this. My mate down the pub said I do this, so therefore can I do this?
My philosophy is ask. It doesn't matter if you think it's illegal or not, ask, because it might be illegal, it might not. Just ask. We're not going to go, oh, you naughty boy.
Yeah,
Just tell you
that's
the
it.
facts.
Get the cuffs in. Let's go. Get them out of here.
No.
I think, and we joke. We should probably not joke about that sort of stuff. But yeah, like you say, everyone's asked this. They'll ask a question. Why do I have to do this? It's like, well, because if you don't, you're going to jail. But let's start really simply. Like on theme with earlier. Explain to me like I'm 5, but not really. Just tell me.
That was more difficult than I anticipated.
Yeah, that was because it is really hard. But when do I need to do a self-assessment?
So, obviously, we're talking about the UK regime of tax.
Yeah.
And a self-assessment in itself is fundamentally an assessment you have to do on yourself. I know it sounds stupid, but people don't realise they can do it themselves. Anyone can. When do you have to do one? You have to do one by the 31st of January, following the year end in which you are trying to self-assess for.
What happens if I'm a dinosaur and I still want to do it on paper?
That's absolutely fine, and good question. End of October would be for that.
Yep.
And if you wanted to code in your liability by the end of December, I believe. So it's another separate small deadline. And just because you think you are a dinosaur and need to do a paper copy, there are other situations where you have to do a paper copy. I believe it's they're called QCs, the high rate barrister type person. They have to do paper copies.
Thanks for calling me out for calling people dinosaurs for using paper. But actually, and I don't know if it's updated, but a few years ago, we had to do a couple of them by paper because the tax software, and I won't mention the tax software, Iris.
Oh, really?
Yeah, it didn't do the thing it needed to do properly.
I'm a big fan of that software.
So we had to. I don't know if it was all ones, but it was very niche. So, but in short, there are legitimate reasons of accessibility potentially, all that sort of stuff we just talked about. But those are the dates. Now, another question that I haven't prepared you for, but I figure out, I should have already figured out, but I figure out on the 25th of January, I've got to do a self-assessment for the 31st. I haven't registered yet.
Oh.
Now, does that mean I've got to register, get everything done by the 31st of January?
Yeah, you do really. You do really. There might be some leeway, as in when you register and you get your UTR number, you tend to have 3 months for late filing. So we'll talk about penalties later, but that you're trying to avoid that. But the late payment is still due regardless. And this is why HMRC have a slogan, if you didn't know. It's remember the 5th of October, because that is the deadline for registering for your UTR number for that exact purpose.
It was on the tip of my tongue. So what types of tax are there and what personal allowances do I have?
Yeah, that's a good question that anyone within the self-assessment regime should know. Fundamentally, you've got 2 regimes. You've got income tax and you've got capital gains tax. And they do intertwine in terms of calculating your tax amount due, but they are also effectively separate strands. So what that means is they have their own allowances. So personal tax, income tax, that is, for 2022 tax year. the amount of times I've said tax already.
Yes.
Is £12,570, I believe.
Correct.
And then for the capital gains regime is 12,300. So this is the amount you can earn in terms of profit or gains before you need to pay tax, not before you need to declare it. That's a separate question. But until you have to pay 10%, 20, 40, 45, whatever it is, percent.
So I'm a crypto trader, and I make about $5,000 in the year, but I have so many transactions. I've traded like all my trades total up to like £1 million, but I've only made $5,000. I'm not really good at it. Do I have to submit a tax return because that's under my personal allowance?
Yep, yeah, absolutely it is. So there's actually another threshold that is quite easily breached within this realm of things, and that's the proceeds threshold, which in any given tax year is 4 times your annual exemption. So 12,300, for example, 49,200.
It's incalculable.
4 times is the limit that where if your proceeds surpass, you have an obligation to report it. Now, you make a joke and say, you're trading all this large volume, but not making much profit or gains from it, shall I say. You don't even need to trade a large volume. If I had 5 Ethereum and I sold it to you for if I had £5,000 worth of Ethereum and I sold it to you for £5,000 worth of Bitcoin, my disposal proceeds would be £5,000. But then we then essentially swap it back again and again and again. We do that 10 times and my proceeds are 50,000, even though my costs are 50,000 and my gain is nil and nothing's really happened. That still counts. So it's very easy to breach that threshold.
Correct. And talking of payments and having to submit my assessment, what happens if I don't pay my tax on time? And also in here, when do I have to pay my tax and what's the payment on account?
Yeah, payment on account is a good question.
Yes, it is.
So
it's a hard one to explain too, but it is.
Yeah. So you have to pay it by the end of January, following the end of the tax year, as mentioned. So say 2022 tax year, you've got till 31st of January 2023 to make that payment. If you miss it, there is, I believe, 0.5% interest per annum on that, which will be constantly calculated every day until you do pay it. Now, I believe that's actually going to go up. There's rumours of that going up, and it hasn't been up for a long time.
So just quickly then, is that on top of base rate, the interest I have to pay?
I believe it is, yes.
Yes.
A very good friend of mine just told me.
The magic of editing. But also, these things change so quickly, so regularly, especially at the moment. And I shouldn't laugh because it's quite a serious matter, but it has changed a lot. And they still don't pay you any much more when you pay your tax bill earlier, do they? No,
so they do have a form of interest that they do pay you if you overpay or whatever it is, and for whatever reason it is. But you're quite right; it's not as much. But yeah, going back to the payments on account question. Payments on account is a payment you make in advance for the next year. It is not subject to capital gains tax. It's only income tax, and it is subject to class 4 but not class 2, I believe. And effectively, if you owe, say, £10,000 income tax at the end of the year, you'll effectively have to pay an extra 50% of that at the same time, and then the balance of the other 50% by July 31st July that follows.
I think this is quite an important thing to explain to people, because I think, especially in your first year of registration, you can get hit with quite a large tax bill. What you've got to remember actually is you are paying 1.5 times your tax bill and then half your tax bill, because you're paying towards next year and you're paying the year just gone. Yep. So a lot of people, if you don't prompt them, they'll go, why on earth is my tax bill so high? But actually it's not. You're just making that payment ahead of schedule, because ultimately that is something I think people don't necessarily appreciate. If I'm employed, well, I am employed. I don't know why I say if I'm employed. I'm employed. I pay tax every month as soon as I incur it. If you are self-employed or you're earning salary, dividends, you don't pay that tax until after the year end or that sort of stuff. So what they are trying to effectively do with payments on account is collect that ahead of it becoming due.
Yeah, that's exactly it. And there's many feelings towards this. Personally, I get it. It does make sense. But like you said, in the first year you pay it, which doesn't necessarily have to be the first year you go into business, because you might be below certain thresholds to pay your payment, to need a payment account being paid. But as soon as you breach that threshold, which could be in your first year, could be year 5, that's when you suffer the cash flow sort of consequences of it. It does come round when you either fall out of the self-assessment regime, you stop the business, or you incorporate, because that's one of the many reasons, one of the many positives anyway, incorporating. There's no payments on account for your business.
Yeah, and so what is that limit that I would need to start making payments on account at?
Yeah, so if your tax bill is over £1,000, then you need to start paying payments on account. The only exception is if over 80% of your taxes that are due are paid at source. So, for example, if you owe if you have £10,000 liability for the year, but through your PAYE income you're paying say £8,500 worth of tax, you've only got £1,500. Technically, that £1,500 is over the limit of what you owe, but because over 80% of your entire tax bill is paid at source, there is no payment on account.
Ah, nice. You should do this professionally too. I know I said that to Joe earlier, but you should also do this professionally. I think you got a career in it. Yeah. So why should I use you when I can just do it myself?
Genuinely, I think everyone should try and do it themselves, no matter how difficult they think it is, because you need to have a fundamental understanding of your finances to some degree regardless. Now, by going to a professional, the main reason I would say is that you have that stamp of approval from a professional organisation saying, we approve this, this is our figures, and we have calculated this, obviously based on the information you supplied, but we've still put a professional spin on it, and we're quite diligent with it all. Yeah. The other side of it as well is, let's say we charge you £500 for a tax return. How long is that going to take you, a non-professional tax personnel, to do that, to create that tax return and do it correctly? Say a week, getting your information, doing numbers, doing tax return, trying again. How much money could you make in a week doing your business?
Yeah.
Much more, I would suspect.
And also, to amend the words of Busted, that's what we went to school for. That one's for free. Sorry, I can't turn it off. Sorry.
You should change your career path.
So in line with that, if I was to do it myself, what's the most common thing people leave off their tax returns?
Most common thing, probably certain expenses that they just don't realise are perfectly normal to use. So if you're a self-employed person now and you've got a laptop that you need because you're advertising, marketing, and do everything on it, at least a certain proportion of that purchase for the laptop is tax deductible. The other side of it as well is if you're a higher rate taxpayer, so anyone who earns a collective total income of 50,000-ish or more, the actual pension contributions, it's just the door, it wasn't me. The actual pension contributions that you may be making through your Nest pension scheme, for example, you only get the 20% top up on that. So if you're a 40% taxpayer, where's the other 20%? So we look to claim that 20% via your tax return, effectively alleviating you of the equivalent in tax.
Yeah.
And you can theoretically use that money to top up your pension, if you like. Most people just pocket it because it reduces your tax bill.
Yeah, I think in line with that, from my side, the real common ones, mobile phone.
Yeah.
Again, especially if you're self-employed, but it's my personal phone. Yes, but you use it for business. You make calls. You manage your company Instagram. Things like that. And also go in. A friend of mine is a DJ, and when he would go, to these, places he'd have to go, and he'd buy dinner, or if he had to buy food on the way, you need to claim that. It's your allow. I've driven my personal car. You can claim mileage. I think I think that also, and it's not really what you miss off, but that's where having a separate bank account for business stuff and personal stuff is so important.
That's one of my top 2 advices and tips, if you like. One is having a separate bank account, keep everything nice and clear. Helps with if you're with an accountant, use a software, for example. And the other sort of top tip, if you like, is to put money aside for taxes. I don't care if you're self-employed or you're within the crypto space, and you just have to put aside money for taxes and effectively run your own PAYE scheme. Because if you don't, you can be in a serious position where the tax is due and you don't have the money.
Yeah, I must say, when I back in the day when I started my journey as an accountant, I didn't see a lot of this. In all business, I think I've seen these days so many more people, and something like Starling's excellent too. You can create spaces for your money, so you don't need separate bank accounts. But I see people now, from a small business, they'll be, well, I'm just going to put 20% straight away. I'm going to put VAT into that VAT account, and I'm going to put money into this account for tax. And it's a really good practice. Yes, it is a bit more admin, but again, if you don't view that money as your own and you're very prudent with it and you do it at a high level, it's great, because when you pay your tax bill, you might find you have some left over, and you've already paid it, and it's such a great way to kind of deal with things.
Yeah, and if you're putting away, say 20%, for example, because you expect it to be a 20% taxpayer, you'll have money for your taxes. You'll have money for your accountant if you're that way inclined, and you might even have an effective tax rebate.
Yeah,
where you now got a couple of grand, and you go, oh, brilliant, that's for me now. I can go on holiday. I can do what I want with you.
I could invest in my stand-up business that I'm going to start on the side. I definitely wasn't watching it myself. It was my partner. She was watching Love Island, and on the break, I saw that they say I can do my tax return for £99 all in. Why should I pay you more when I can pay somebody that?
That's a good question, because there is no real reason that to not use that particular service. There really isn't. The difference is you get what you pay for. Genuinely. Are they going to get the job done? Yes. Are they going to give you a bespoke custom with tax planning and looking after you like a partner and changing things and advising you? Absolutely not. So if you have a very simple set of accounts that you just need someone to populate the boxes and submit it, by all means. But if you have something that needs a little bit more of a personal touch and a little bit more of advice, or just a little bit more, then it's not going to be what you need.
And I would also go a step further and actually say, yeah, if I would say salary and dividends as your 2 sources of income, but actually you wouldn't go use that separate service if you had an accountant. How, for instance, we include that for our directors of our limited companies. But if it was that simple, yeah, go and do that, because you're effectively paying someone to put it in the box. Anyone can do that.
Yeah.
But if you are a crypto trader, I guarantee you they are not going to do it properly for that price.
Absolutely.
Because there's no way that works. We know, and it's not about making money all the time, but I know how much time goes into producing a tax return, and it is quick. You can do it quickly if the information's spot on. If you don't validate it yourself, if you don't check transactions, of course you can, but you need to do that if you want to be a reputable accountant.
Absolutely. I think genuinely, from my perspective, and yes, I've worked my way up through the ranks. I'm not necessarily a drafter anymore, but the actual population of the tax return itself, 5% of my time.
Correct.
Genuinely, everything else is gathering information. It's talking to clients about, okay, this is what we're going to do and why. Are you expecting to, are we reducing payments account? Are we incorporating? Are we tax planning here? Are we got any pension contributions? That's all. The service isn't a tax return. The tax return is the vehicle in which the information that we have gathered and manipulated to show what we wanted to show and to be where we wanted to be is going on.
And also, ultimately, from an accountant point of view, if you're not the cheapest, no one's going to use. You know what I mean? If you're in that market, it's such a convoluted space. And I think, for instance, marriage allowance. If you're a basic rate taxpayer and your partner doesn't earn any money, are they going to think of that and go, John, let's have a discussion with the client, let's transfer this allowance,
Yeah.
So 100% I agree with you. And now a bit more, back to my mate down the pub. He's told me he's made a lot of money from crypto.
Good lad.
But he's not transferred it to fiat, to GBP yet, so he doesn't have to pay any tax on it.
Yeah, I mean, your mate down the pub.
He's a dodgy bloke, isn't he?
I get where he's coming from. I get that, but it's a huge misconception. Fundamentally, crypto is an asset, and it's about the disposal of the asset. So if you were to go back to our example earlier on, I've got £5,000 worth of Ethereum. I traded it for £5,000 worth of Bitcoin. That trade is taxable. In this situation, there's no tax to pay, but it's still a taxable event because I have disposed of Ethereum. Yes, by disposing of Ethereum again to fiat GBP, yeah, absolutely correct. That is a taxable moment. But the taxable moments leading up to that are plentiful in most portfolios. Portfolio. I can't say that word.
Numbers, not English.
Exactly. How to tax. Yeah. And so, yeah, it's a huge misconception. I believe from my own conversations lately, it's a lot less prominent in the space than it once was.
Yeah.
But it's still there.
Yeah, for sure. And I guess this next one, I'm down the pub again, and I know it's the tax years.
You've got a drinking problem. It sounds of it.
No, so I'm down the pub. It's nearly the end of the tax year. It's the 29th of March. I'm looking at my portfolio. I'm going, do you know what? I'm just going to sell a load of my coins now. Coins? Why did I say coins? I'm just going to sell. I don't even.
You could have some crypto
I could have some
coins.
I could have some crypto coins. What's the crypto? I'm going to sell a load of my crypto now, and I'm going to buy it back after the tax year because I'm going to realize my loss now, but I'm going to buy it back on the 6th of April. But my mate is talking about bed and breakfast, and I don't need to go to the bed and breakfast. What's that?
So fundamentally, that thought process is correct. Like, tax loss harvesting before the end of the tax year is wonderful, definitely. The problem is this bed and breakfasting thing. This is part of the Section 104 pooling mechanism, if you like. I know. Where if you were to repurchase those assets within 30 days, the base cost is actually calculated in that section, so the sale and the purchase there rather than the initial purchase. So you effectively negate what you're trying to do. The only way around that is if you don't buy it back within 30 days. Now, that's all well and good, but we, as crypto investors ourselves, know how much can change in 30 days. Yeah. So it might not be something you want. It might not be something you want to do. But yeah, little things like that, so important to know.
Do at your own risk.
Yeah, exactly.
Very much at your own risk. So also, once again, my mate, he's just chatting so much rubbish down the pub, but he wants to know. So he's made a lot of money out of crypto, but he doesn't want to pay any UK tax on it. So he's just going to go to Portugal for like a couple months, live there, take all that cash out, and then come back, and he's not going to pay any tax on it, because obviously Portugal's a very, they have no personal tax rules on it at the moment. But yeah, he just thinks that's the way he's going to do it and get away with paying no tax.
Yep. Again, the thought process is almost there. The problem with that is it's not about leaving the country. It's not about being in Portugal itself. It's about, are you considered a UK tax resident or not? In that particular case, you probably still are. Chances are you still are. So certain things like if you were to have actually genuinely moved to Portugal, that would work as long as you don't fall back into this system. Anything that you purchase prior to leaving the UK can be sold out there, and you won't suffer any capital gains tax unless you do fall foul of falling back into the UK tax system within 5 years of you leaving, which is quite a niche and an important note to make. At the same time, if you were to come back in 3 years, but anything you purchased out there and you're making gains out there, so you purchased the asset and then sold it out there, doesn't matter. You don't have to stay out there for 5 years. It's only anything that you purchase prior to leaving the UK tax system. So, and that's a very, very quick nutshell. If you wanted us to create this document for you, for example, it would be pages and pages of just tax and legal jargon, which effectively in a nutshell says that.
Yeah, and I think the big thing for me with all tax planning, be it limited companies, personal tax, all these things, I always say, what are you trying to achieve? What's the point of this? It's all well and good saving tax and not paying tax. The flip side is, I always describe it this: if somebody has a large tax bill, you are fortunate enough to earn enough money to pay the tax bill that you have. For instance, to save tax a lot of the time, you need to spend money. You need to get rid of it. There are different ways, loads of different investment things that you can do. It's not guaranteed to come in. You've got to spend that money. I always describe it sometimes, if you just want the most possible money now, take the tax, pay it, move on. You have the cash. It's, you've dealt with the taxes. You are free to do as you wish with it. And obviously that doesn't apply for everyone. And, like I say, we have very specific advice we give depending on people's situation. But it's great being tax efficient, but you can't, I was going to say about a mortgage, you can't get a mortgage if you're really tax efficient because your earnings are really low.
Yeah.
You've got to, that's probably more a limited company thing. So we're going a little bit towards that. But that shows, you need to declare the income to show or to live your lifestyle. So, yeah, I guess that's my last kind of piece of advice in that before we go on to the favorite topic of mine about making tax digital. But if you could give, I was going to say a younger Jamie some advice, but actually, if you're going to give,
don't drink it. That's my advice to younger Jamie. Whatever it is, just don't drink it.
Just don't drink it. Yeah, don't buy pops would be mine. But again,
don't eat yellow snow.
Don't buy pops. Please don't cut that. But what would that be to say somebody now who's made a load of as we've seen 19, 20-year-olds, any age really, but you've made a load of money. What do you do? What's the biggest piece of advice you could give someone right now?
Talk to two people. Talk to two people in particular. The first one is someone you trust, regardless of their background, family, or wherever they are. Someone you trust. Talk to them first. The second person is an accountant or financial advisor. If you come into some serious money very quickly, you need to be in a position to protect yourself and to talk to someone openly about it, because I know we're focusing on the financial element of it and keeping yourself sort of financially independent to an extent. But you can't do that if your head's all over the place, which is why you need to talk to someone you trust. I know a few people who have called me in the last couple of years going, Jamie, I've just, made $1 million or whatever it is.
No.
I love it. Good for you. And I need your help because I don't want to pee my life up the wall. And I get that now because it happens more often than you think, where you see people win the lottery, for example, and they just ruin their lives. So, yeah, if you're a younger person who's come into a lot of money, say in crypto, for example, or anything like that, talk to two people. Someone who's financially in the know, accountant, financial advisor, and someone you trust, because they might have an idea and go, actually, I know a guy, or whatever it might be, because let's get your head sorted out.
And I would add to that, as early as possible.
Yes,
we can plan and we can improve your tax position in the year it happens, but we're not magicians. We can't do it in a previous tax year after the year end. We can't magic transactions up for you.
Absolutely. And you might be in a lucky position where, let's say with negligible value claims, for example, where you could effectively backdate a loss, if you like. But unless that opportunity presents itself and we happen to be in the picture and we're doing the tax return and it's someone comfortable doing it, you're just going to... Yeah.
Don't rely on luck to get your taxes right.
Just don't. Yeah.
And I guess it's probably, it's definitely on your radar, but probably not as much of a pain point for you as it has been me. But making tax digital for individuals and self-assessment.
Yep.
Coming, all things being right, coming 6th of April, 2023. What is it? What do people need to be worried about? And I guess, tell us what you know about it.
Yeah, so this has been on the horizon for a while now. From a client perspective, I suppose the things that you need to know about is it's quarterly reporting, it's digital reporting. So if you're one of those that gives your accountant a load of receipts, that's just not okay anymore. There are ways around it, I know, but it's a real bugbear. So quarterly reporting, all this, I believe from rumors, I guess, that the reason for this is because they're looking to potentially reduce the VAT threshold, and then have everything in line. So let's say you're a self-employed personnel, you've got quarterly reporting, so you're reporting your VAT and your self-assessment every quarter in line, and then for a final reconciliation at the end. Now, I'm not going to lie, and I'm going to be completely frank, it's hard enough getting clients to send in their information for one deadline. And that's not against any clients or anyone at all. Life gets in the way, I get it. Important things are always going to be taking precedence. So to have this quarterly reporting where we don't have one deadline, we have 4, can be a real pain. So I suppose my thoughts on it really are, if we can get to a point now where we are doing things like you said about the bank account, making use of software, getting that to that routine of being helpful, that will help everyone involved, because it is a big change. For example, like, are we going to charge 4 times as much for the same amount of work, but we're kind of doing it 4 times? Yes, no, maybe, who knows? It's just a bit of a shake-up, really, with the whole industry.
Yeah, and I've seen, let's see what you think of this advice. I saw on LinkedIn the wonderful joys of accountants and just kind of the lack of foresight in this. I heard somebody say that it's fine, all they're going to do is incorporate every single sole trader they have on their books. So to get away from increased administrative duties, they're going to increase administrative duties. Yeah. So it's initially, and our kind of strategy at Nephos has changed a little bit. Before, obviously in Myna with the crypto stuff, self-assessments are bread and butter. On the traditional accounting side, hasn't been massively. There's no real burning desire to do that unless we have to with the limited companies. However, I think making tax digital is a massive opportunity for accountants, for clients, for everyone involved, because yes, it's going to be really, really annoying and frustrating to have to chase clients 4 times a year for this information, and from clients' perspective, it's going to be really annoying to do that. However, as we've seen with like making tax digital for VAT, clients are just more in tune with what's going on in their business.
Absolutely.
If you're a landscape gardener and before you've done your accounts on a year-end basis and you're literally getting your stuff to your accountant in January and you go, oh, my tax bill's 10 grand. Now you're going to have that opportunity 6 months in. Oh gosh, my tax bill is now 5 grand so far this year. What can I do to either mitigate that? I need to buy some new equipment. I need to do these things. Or that's great. Let me start saving for that. And it's going to improve that. People are going to want to understand their business better. And I think it's forced change. It massively is. But I think it's part of a digitalization of the whole world, really. The whole tax system. It does need to happen. This I'm just going to incorporate every client. Not really what I'm thinking, if I'm being honest. I'm not about making my life easier to spite our business owners.
It's not even about like making your life easier, because you're not really. All you're doing is, like you said, transferring the admin burden from something you don't know much about to something you believe you know enough about to deal with. And eventually you're going to have to learn about it anyway, so you're just going to be behind the curve. I do learn. I do get the mindset a little bit. Let's do 1 year reporting, because if I'm not VAT registered, I don't need to worry about that. But like you said, that doesn't change. You need to address the core issue. It's interesting. I speak to some software providers and things like that, and they were telling me, this happened with making tax digital for VAT. Clients and people were like, no, they're just going to get rid of it. They're not going to bring it in. And I know there was a firm that they did nothing to do with it. And obviously, straight away, that got brought in. Or like, what are you going to do? You've not prepared for it. So, so you just can't do that. So at Nephos, we're big on technology, innovation, being there for our clients. So from a crypto perspective,
thankfully, we have lots of tools in place already to help with that. So we're kind of ahead of the curve there anyway. And if anything, us having to do the crypto transactions on a quarterly basis, I see it as a better thing. So we can give better advice. Yes, we're going to have to charge more a little bit, but from a crypto perspective, we kind of charge more anyway because we have to. The checks, the compliance, the added transactions, we have to do that. So I think that side, really fine. I'm looking forward to it because this is where Nephos and Myna are going to excel compared to other accountants, because you talk out there and no one really is really prepared for it yet. And be honest, we're not 100% there yet. We still need to do pricing. We need to identify the software that we're going to use for the non-crypto people. But ultimately, we're going to get there, and we're going to do it from the 6th of April. So it's a big opportunity.
It's funny you mention opportunity, because I think there's going to be a huge scope of opportunity for accountants who are looking to move into a more senior position. The reason why I say this is, if you think about your stereotypical accountancy firm with your elder gentleman, let's say, who's at the helm, if you're thinking about potentially retiring early, when are you going to do it? It's probably going to be when the fundamental system changes to a quarterly reporting, for example, with making tax digital for ITSA, and go, you know what, rather than learn that, I'm going to retire early,
Yeah.
And then you've got opportunities for people to buy in, other firms to come up and just do well on this new thing that your traditionalists, if you like, and your older, I say older because you're closer to retirement age, and to retire and make room for you guys to come through and do a thing, and make yourself known. I have no doubt in my mind that in the next year or so, there's going to be some random, not necessarily random, like this odd firm that's not really on anywhere near the top 100 go, bam, they're in there, just like that.
I reckon I know a firm who might be trying to do that.
For different reasons, perhaps, but yeah, the exact same concept, we're taking the bull by its horns and going, right, let's run with this.
Yeah.
And there's one option, we do it. That's literally it.
Yeah.
There's no other option. Just like anyone else moving into the positions where these more senior members of the organisation go, you know what, I'm out. I can retire. I'm gonna, rather than put myself through this for another 2 years of new things and trying to redo it. I'm just out. Yeah.
And I think, again, with the technology we use, and this is a topic for another day, but AI is not going to replace us. No. It's going to be and I guess AI is not going to replace the accountants, because actually it's a combined effort. It's man and machine. People and machines here, because where we will have an advantage, I really hope, is that it will be that advice. We can automate as much as we can, and we can use rules and things like that in the softwares to keep that cost down. However, the cost is going to be a huge problem. I think that's probably where HMRC didn't think it through with the 10,000 limit. Let's be honest. No accountant worth their salt should be doing, quarterly reporting, all that sort of stuff. If they're the one doing the actual processing of the information, for under £1,000 a year, really, but that's 10% of somebody if they're just over that threshold. So I think that they, who knows what they will change between now and then. But yes, I think it's coming. It's going to happen. But it's a huge opportunity. And I think, like I say, huge opportunity for accountants. But I do massively think people will benefit from it too. I think the tax system will be better for it. I think more people will know about the tax system. People will be better educated on this stuff. And yeah, I think if you could, for me, again, younger Jamie, or, said, self-employed individual out there, or, crypto traders out there, high volume transaction people, whatever it is, what advice ahead of the 6th of April what would you give people as a bit of advice
for the end of tax year tax planning?
Yeah.
I suppose look back and reconcile things to the best of your ability. It doesn't have to be anything official. Just have an idea of where you are, because you might be surprised. You might have made a lot more, a lot less than you think. A lot less you can tax plan accordingly. A lot more you can certainly tax plan accordingly. Yeah. So that would be my advice. Just very quickly as well, in terms of going full circle, when you're talking about AI never replacing us, it's a self-assessment fundamentally. You're supposed to assess yourself, but we still have jobs as accountants because people go, they can do it better than us. So you're absolutely right. AI will never effectively take over that part of it, because there'll always be a proportion of people going, I could earn more money by doing my thing and pay someone else less to do that better than I can. You know, it's a trade of services.
And again, I know it's not necessarily specific to taxes, but I didn't get into accountancy to play with spreadsheets. You know, I got into accountancy because I wanted to help people understand their business and, you know, their personal tax situation. There's nothing better than, in my mind, you know, helping an individual and saving them tax, saving them their money in their business. You know, that's tangible, you know. And that's something we're going to need to continue to do. And this tech that's coming in just helps give us that opportunity. Yeah. And it's the threat for those that aren't doing it or embracing it. But I think to kind of end there really is the budget coming up in a few. Which one is it now? How many iterations of it have we had?
Lost count.
What would you like to see from a personal tax point of view? Yeah. And I'll cheat. I'll let you even mention potentially a crypto regulation or two. Yeah. What would you like to see?
Just something concrete. Like, and I know it sounds like a throwaway answer, but genuinely, if it's been changed a couple of times already, I want something that not necessarily shocks the nation, but something that goes, oh, hold on, we're actually doing something about it. Like, ideally, it would be wonderful to have a whole new digital tax regime, aside from, say, income tax and capital gains tax, specific for crypto type assets. That would be wonderful. Do I see that happening ever? Let alone now, probably not. But that would be nice. What would you like to see?
Wow. World peace.
Yeah.
No, the easy one, and again, it's not necessarily personal tax, but I'll mention it quickly and then mention a personal tax one. I'd like to see large corporations pay more share of their tax. I understand why they do it. You know, we all tax plan, and these big companies do that for them. Lovely. I think they take advantage of the benefits of, you know, our country, for instance. They should pay more tax as a share of it, because I think the people who get unfairly punished, in my mind, by the tax system at the moment is those worse off. So if I was, you know, my ideal situation, I know these things don't move without different, the Laffer curve, so it doesn't quite work in isolation. I would like to see the personal tax allowance significantly increased, because that will give help to those at the lower end.
Absolutely.
And a way, I guess, to kind of also, I would like to see the reduction of the personal allowance changed.
In what way?
I think incentivizing people to earn more money at in that, once you earn 100,000, again, people are 120,000 and more, my heart bleeds for you having to pay that extra tax. But it does incentivize, it does decentivize people from earning, you either earn 100K or you earn significantly more. And I think
you don't want to be in that little
if you're in that little bit in between where you're effectively taxed at about 60%.
That's exactly it. Yeah.
I think that is wrong. Maybe do it a quarter rather than for every £2, maybe every £4 you lose. So again, that brings that effective tax rate down. But that's giving with one hand, making sure right at the bottom we're taking care of those people. Because cost of living is it's really serious, and I was talking to Lucas on our way over. Our mortgages we've just had to remortgage, and we're really fortunate that we've been able to extend our term to keep our payments relatively to where they were. Not everyone has that benefit, and it's gonna take time. So there's my little how to save the world in 3 minutes, but. Let's end there, and we will. I'm sure we'll have more, because it's much easier and more professional without Joe.
Yeah,
and that concludes.
Do you reckon Joe watch this?
Yeah, he's not going to watch it. So we'll leave you once again. Rule number 2: a little bit more to come.
Perfect.
Thanks for listening. We'll speak to you soon. Bye for now.